And it's the first one for the week. Thank you for joining us on on Business Morning, live on Channels Television. Well, let's first take a look at what's happening in the oil market. Oil prices rose today after Saudi Arabia's state-owned oil producer, Aramco, raised the official selling price for its crude, suggesting demand remains strong at a time of tighter supplies. Brent crude was up by 90 cents at $83.64 a barrel after dropping nearly 2% last week. U.S. oil gained 87 cents to $82.14 a barrel, having declined almost 3% through Friday. Aramco, late on Friday, raises December official selling price to Asia for its Arab light crude to $2.70 a barrel, versus Oman, crude up $1.40 from this month. Analysts say the move by Aramco suggests demand remains strong as the OPEC producer and other major oil exporters keep the reins on supply. And back here, the Central Bank of Nigeria has fixed 5 billion naira maximum loan limit for its new financial instrument known as the 100 for 100 policy. The CBN disclosed this in its guidelines released over the weekend, adding that any amount above 5 billion naira shall require the special approval of CBN's management. According to the CBN, the initiative, which shall be bank-led, will be rolled over every 100 days. That's quarterly, with a new set of companies selected for financing under the initiative. The 100 for 100 policy initiative is part of the CBN steps to reverse the country's over-reliance on imports. And as part of measures to reduce the suffering of pensioners in the country, the Pension Transitional Arrangement Directorate has introduced an online verification exercise to enable pensioners confirm their status from the comfort of their homes. The Executive Secretary of PTAD, Dr. Chioma Ejikeme, who unveiled the pilot scheme of the project at the South-South Pensioners Stakeholders Engagement Forum in Uyo, Akwa Ibom State, says pensioners will no longer be required to present themselves for physical confirmation. Do take a listen.
Our new baby is the I Am Alive confirmation solution. Now, this is a web-based solution that enables the pensioner to get his aliveness confirmed from the comfort of his home using a smartphone or a computer system. You know, we're used to having these field verifications when we move our pensioners from one point to the other to get to know whether they are alive or to, first of all, what we actually did was to capture our pensioners on our database. We got them verified. So having gotten them verified now, we have to continue to be sure that they are alive. And we don't want to continue to put them through, to come to the field, move from Akwa Ibom to Rivers to go and get verified. So we are looking for how to make it convenient for them, user-friendly, something they can do from the comfort of their homes to assure us that they're still alive.
Welcome back. You're still watching Business Morning live on Channels Television. Well, for our first conversation now, for the second consecutive quarter, the manufacturing sector's real GDP grew by 3.49% year on year, the second quarter of 2021. That's the highest growth since the first quarter of 2015. So this can largely be attributed to the low base in prior year. Recently, the Nigeria Investment Promotion Commission reported $8.41 billion new investment announcements in Nigeria in the first quarter of 2021, with the manufacturing sector attracting about 60% of that. Well, I'll be discussing the drivers and issues arising in the sector with Mr. George Onofowokan, MD, CEO, Coleman Wires and Cable. Great to have you on the program this morning.
Thank you for
Happy
having
Monday.
me. Happy Monday to you too.
Well, it's 2021. You know, year after the pandemic, the world has been disrupted by the pandemic and other, global issues arising from shortages and all of that. How would you describe the performance of the, manufacturing sector in Nigeria, post, the COVID year?
I think the performance has been, for my own view, coming out right. We had to have an optimistic look for 2021. being on the fact that we had a dull pre-COVID and post-COVID, late 2020 was not looking as realistic as coming out of post-COVID as we all thought it was. So everybody's expectation was looking at 2021. And if you look at everybody's year-on-year in growth, everybody expected a rebound in 2021, and we're all seeing that rebound. And the manufacturing sector has benefited, I think, a lot more than expected from the post-COVID era. And it's normal because you had a very, very negative position of manufacturing, and demand levels was very low in 2020. And for 2021, the demand levels was expected to more like be far than expected, and that has been seen all over the world, not only Nigeria. And with that, we've already seen this expected logistics and pricing, supply chain issues that's happened everywhere in the world, because at the same time, we're all having the same demand levels all at the same time. And the manufacturing sector is benefiting a lot from that.
Yeah, but what about, had these challenges with, raw materials and access to credit? How would you describe, policies by the government and central bank regarding, credit, accessing credit for manufacturers?
I think one of the benefits that we've all seen that has impacted positively on manufacturing or investment within Nigeria has been the policies, especially from the CBN side. If you look at the aggressive I'll say more like aggressive and deliberate lending, which when you look at the loan-to-deposit ratio of the banking sector, which has forced every bank in Nigeria, if you look at the growth rate of liabilities of banks and asset creation, we've seen that the banks have actually been lending a lot more because the CBN has actually been penalizing a lot of banks on LDR.
Right.
And that has seen more funding coming into the system. We had a negative position, actually, when you look at the issue with regards to debt raising, debt capital. The debt capital market, because of the rising interest rate from Treasury bills and the rest of the long-term debt capital market, in the first 2 quarters was not that brilliant. But I think now the market, everybody, in this last quarter, we should see a rebound in that. So with the lending going into the sector, a deliberate policy to actually put lending out, I think that lending has gone more into the manufacturing sector, and the manufacturing sector has benefited a lot from that. And I think the country is beginning to see the benefit of it. And if I look at from our own perspective, if I look at it from my own perspective today, if I look at that, we've seen more support for the industry. I've seen more support from the industry for Coleman, for instance, and that has seen more growth and more investment. If you look at the number of investment we're tailing out now, you're seeing a lot more aggressive investment going in. We're doing a lot more fiber optic now that we're doing. We should be up in that first quarter of next year. And there's so many investments coming into play. We're pushing in over $50 million of investment. So if you look at the statistics of everybody's investment flow, it's actually getting a lot better in the manufacturing sector. And that is why we're seeing those informations coming out. Right?
And obviously, the NIPC, stated that manufacturing industry had got the more attention when it comes to investment announcements. What does that tell us at this point?
It tells us that if we continue to focus our investment of in-country, and I think for me, when I looked at the NIPC investment with 7.8 billion, 7.29 billion. I think the critical part of that NIPC is to look at what the domestic investment is. It accounts for 42% of the actual investment.
Quite big.
And that itself for manufacturing, with the majority of it coming from domestic investment, not foreign direct investment. And that is where we should actually see the growth coming from. Domestic investment will continue to grow rapidly because of these direct, deliberate policies towards local investment, localized investment, as in companies based in here. It doesn't matter whether you're Nigerian or foreign. It's actually companies that actually, so they're having more access to funds. The only problem, of course, it deems a fit where no matter how there's still a glut and there's still a problem with the issue of FX raising. But I think generally they're beginning to rebalance itself. I think once we start seeing a Naira rebalancing or a Naira equilibrium between the black market, the foreign market, and the INE and the SME and all the windows, I think that will stabilize itself. But most importantly, you're actually seeing domestic lending and domestic companies actually getting the lending and now interested in actually pushing investment in that industry. And you have to remember, Nigeria has 200 million people. No matter how you look at it, we need to actually generate investment. The risk appetite for Nigerian business is actually dwindling. So we might be looked at sometimes as high risk, but I think the risk appetite for investment in Nigeria is a lot better now.
Okay, so but should we be worried, that, domestic investors are the ones, pushing more at this time, and we're having less, foreign direct investment. Looking at this, should we be worried at this point?
I think we should be pleased.
Okay.
Being worried, I think it's a negative way of looking at it. I would rather that Nigeria has more domestic investment than actually foreign. Now, why I drive at that is that you have to look at it from a different perspective. Now, foreign investment is fantastic. But where does foreign investment go in Nigeria? Most of the time, it's services, telecoms, stock markets, debt market, and treasury bonds and money market. Now, when it comes to manufacturing, it's not as high. So we cannot, and the reality is, who drives your economy? Now, there's nobody on the long term that could drive your economy as much as your indigents themselves or domestic investors. The way we would plan succession planning, for instance, on a long-term basis for a domestic investor is very different. You'll be looking at second, third generation succession planning. Now, for a critical fact of it is that foreign direct investment in manufacturing, sometimes, especially when it privately run investment, don't last as long. I've had the case of a Chinese company saying to me that they've made a very sizable investment. If I look at their investment in Nigeria, it's been between $10 to $20 million. But the fact of the matter is, the statement from the gentleman was that, look, my business in Nigeria is 10 to 15 years, at which I would exit. I would sell off the business because I don't expect my children to actually come and sit in Nigeria. Now, so how do you want to drive investment into manufacturing sector if we're going to be looking at foreign investment when you have examples like that? We're not saying we don't have foreign investment for multinationals that have more long-term view, because those companies are older, they're well-structured, they can actually stay the test of time and stand the test of time. But for domestic investment, I think it's key that we actually look at how we support domestic investment to create long-term solutions for our own businesses in Nigeria.
And what do you think can be done to, encourage more domestic, investment at this time?
I think the word is always the word deliberate. As in deliberate in the sense that we need to find businesses within Nigeria that have sustainability, they have that can impact the country or impact investment in the right way, and deliberately invest into them. Okay. And in terms of government policies, either get towards getting them interest from development banks, which we have, and focus on those sectors the same way we've done with the agri sector and some certain industries. We need to continue to focus on those policies. Now, you have the 100 for 100 from CBN. I would expect those things to be focused, which from what it is focused on domestic investment to generate and actually remove ourselves from dependency on imports, creating employment. So if you look at the criteria on the 100 for 100, for instance, those are the things that we need to see. And those are the type of policies. But it should not only be just dependent on CBN pushing every policy, for God's sake. And I think we need to look at all the executive orders and actually make sure that they're being impacted. Because you cannot say local content or local purchase in executive orders. And in reality, it's just hearsay. When you look at some of the tenders, they get towards foreign companies. And if you look at some of the tenders that get towards foreign companies, it doesn't make sense because some of those products are widely available in Nigeria. And if I have to put out a company like TCN, for instance, TCN does not participate in local content. And it's sad to say. they can show us how many companies have been local in their history that they've done business with locally. And you have cable manufacturers all over Nigeria in the last 60 years. And you look at their statistics, it's very poor. So you have government agencies that have very poor local content development. And that is what we need to, that would evolve and increase capacity in local content. If businesses see opportunities, more investment will follow.
Right. Okay, looking at the NIPC report, we see that Ogun State and Lagos got a huge chunk, when it comes to the investment announcement here. What do you think other states should be doing to actually, attract them? Why is Ogun State getting so much attention?
Ogun State as a state has been a very, very, I'll say, too well positioned. If you look at it, if you take Lagos, for instance, Lagos has the port, has all the infrastructure, but its land is too expensive. But they will get investment in. If you look at, I'll say, most of the telecom and the service sector investment go to Lagos State. Nobody can argue with that because they're well placed where they are. But when you look at the industries, a lot of the industries are now moving outskirts. So Lagos, the one time I was in opportunity to be at one of the events of Lagos State and I spoke and luckily spoke with the governor was there and I said, Lagos, let's accept Lagos is our New York. It's going to be our finance center. It's going to be our telecom center. It's going to be our hybrid center. Ogun State is going to be our New Jersey. It's going to be our industrial zone. We have to just accept certain areas will be focused on certain things. So because of the proximity, the availability of land is better in Ogun State. The proximity to Lagos and the port is there. The gateway to the other states is there. So technically, Ogun State is so well positioned. So it has a lot of advantage. Statistically, over the last 10, 15 years, Ogun State has benefited from a lot of industries opening up factory and setting up shops in the state. Other states can benefit. And I don't see it. We have states like Rivers State, I believe, is also getting a lot of benefit from it. And you have some of the Southeast states and some of the few northern states. Now, but the fact is that not many states out of 36, I think the figure here shows is mainly 8 states that have benefited from it. But we can get other states to benefit. It is not that difficult to have investment in your state. The problem with investment in most states is that it is not seen to be viable unless those states are also deliberately looking for those investments. You need to make access to investment easy. Taking, for instance, simple things like telecom, for instance. Telecom now, data has become a critical part of telecom. Data flow now today, data transmission is by fiber optics. Until Coleman is putting this fiber optic cable plant in Nigeria, there's not. Now, we are putting in over almost 300, 400,000 kilometers of fiber, multi-fiber kilometers a year. Now, but that solution, when I looked at it today, is not even going to solve our problem. Because why? Access through the states. If you look at Lagos, fiber access is getting a lot better. If you look at Abuja, it's not too bad. Some of the states. But we need to create investment-friendly zones whereby this states will come in. And that's what I say.
All right. So, these are the announcements. We'll be watching to, track how they actually materialize, moving forward. Mr. George Onofoweko, CEO, MD, Coleman Wires and Cable, thank you for joining me on the program this morning.
Thank you very much for having me.
All right. So, after the break, we'll look at some bank earnings. That's in a moment. Do stay with us. This is Business Morning. Welcome back. Now to our next conversation. Our third quarter earnings season is gradually winding down and almost all banks have posted their earnings. Well, let's take a look at how they fared. And we have Damilola Olukpon, our banking sector analyst with Chapel Hill Denham to tell us more. Great to have you on the program. Good morning.
Yeah, thank you very much. Thanks for having me.
Yeah, so can you give us a brief overview of the banking industry earnings over the 9 months of 2021?
All right, thank you very much. The 9-month earnings for banks, has been a bittersweet experience. Bittersweet in the sense that we have banks, who have reported an higher earnings, over the 9-month period. And we also have banks, who have reported lower, earnings per share over the same period. You would recall that Nigeria is just coming out of a year, that was largely challenging. Last year was laced with COVID-19 pandemic, and we had that, filter into 2021. And we've seen banks, grapple with some of the pressures, that started last year. And, these pressures, have come in form of lower interest rate environment, which has limited some banking players, which has limited their ability to earn higher interest income this year. On the other hand, as well, like I mentioned, the lower interest earnings, also translated to lower cost, for the banks as well. So while we have some banks, some tier one banks, like GTB and Zenith, reporting slightly on impressive earnings this year, we've had other banks, the likes of UBA, Access Bank, reporting higher earnings this year. So generally, it's been a bittersweet experience, for the banking industry.
All right. So, but what would you say were the major drivers of earnings over this period?
Okay, the major drivers of earnings, was what I mentioned before, the interest rate environment. You would recall that sometime last year, we saw fixed income yields, decline to single-digit levels. And, that filtered into the first quarter of 2021. So what that meant for banks is in terms of their earning capacity in investment securities, that largely impaired, their earning capacity, their ability to earn interest, from their investment security books. But, aside that, like I said, we've seen banks as well, report lower funding costs, cost of funds, for most banks, have declined as well. So it depends on the balance sheet structure. For banks, that ordinarily would have the higher interest rate environment, lead to funding cost pressure. In 2021, we've had banks like that, report solid earnings. I'll just mention a few, the likes of Access Bank, the likes of the tier two banks as well. The lower funding cost, has been a major booster for earnings for them this year. For on the other side of the curve, banks like GTB, that have large CASA deposits, the lower interest rate environment has not really benefited them much. And that was what, translated to the lackluster earnings performance, for 2021. So in terms of the major drivers, I would just say the interest rate environment, has been the major driver of earnings, for most banks this year.
All right, but who are the biggest winners and losers in terms of earnings over the period?
The biggest winners and losers, in terms of earnings this year, I would say UBA. UBA is one of the biggest winners, this year. In terms of profit after tax growth, the company reported a 35.6% increase in their profit after tax, this year, which is largely impressive. You recall that last year, bulk of their Pan-African operation, was largely impacted by COVID. And this year is just a rebound, from the low base, we saw last year. Access Bank as well, reported steady earnings as well. Over the 9-month period, profit after tax grew 19.1%, which in our view is very impressive. But for the likes of Zenith, Zenith earnings were largely flat. They only managed to grow earnings per share by 0.8%, which in our view, is largely flat. But for the likes of GTB, GTCO, and Stanbic, they reported lower earnings this year due to the factors I mentioned earlier on. But I would just like to mention that for Stanbic, aside reporting lower interest income this year, from their trading book, we didn't see so much earnings, coming into this year. Trading books saw a large decline this year, and that affected overall earnings this year on an EPS basis, earnings per share basis. Earnings were down 39.6% on a year-on-year basis, which in our view, is not impressive. So in terms of winners and losers, from a profit after tax basis, I would just say UBA, Access, were the biggest beneficiaries this year. Whilst other banks, are still struggling to hold their ground.
And how have the markets, priced these earnings? How are investors reacting?
Investor reaction have been largely mixed. We've seen a couple of corporate actions, coming to play, this year. I'll just mention that for FBNH this year, the stock price, has gained more than 50%, on a year-to-date basis. And bulk of the interest we've seen in the share price of the stock has not been largely driven by their earnings this year, but it has been largely driven by some corporate actions, that's currently happening, within the firm. But in terms of how they've priced these earnings this year, on a year-to-date basis, aside the likes of FBNH, First Bank, aside the likes of Access Bank and ETI, EcoBank, most banks have reported a negative year-to-date share price performance, which largely speak to the pressures, I've mentioned, earlier on. In terms of earnings growth this year, aside UBA and Access Bank and maybe Fidelity Bank, on an half-year basis, most banks, have reported lower earnings this year. And investors are just looking to corporate action events and, other speculative news, to just drive their interest in the stock, as against the earnings performance. But for us, our view is that going into the rest of the year, we'll start to see renewed interest in banking sector names, particularly as investors, reassess the dividend positions, of these banks. On a dividend yield basis, the dividend yields for most banks, are currently attractive. Attractive than the one-year treasury bills, which is currently around 6 to 7% region. Just to mention a few, the likes of Zenith Bank and GTCO, barely double-digit dividend yield opportunities, for investors. So I would expect that as we go into the rest of the year, investors will begin to reassess these positions, and we'll see buy sentiment, those prevail, across the banking sector names.
All right, Damilola, let's look at lending now. How's the banking industry, non-performing loans, evolved since COVID-19?
All right. The non-performing loans, have been somewhat low. We've since the emergence of the COVID-19 pandemic, we've not seen a sizable increase in non-performing loans, and that is thanks to CBN's COVID-19 measures. We saw some forbearance measures by the CBN, and the CBN allowed most commercial banks, provide, allowed most commercial banks, restructure their loans, on a case-by-case basis, depending on how that particular sector has been largely affected by the COVID-19 pandemic. So I would say that has masked the pressure we would have seen, if the CBN has not stepped in. So for now, the non-performing loans, are still within LD regions, as at half year 2019, as at half year 2021, across our coverage banks, non-performing loans, was hovering around 5% to 5.5%, which was even an improvement from the 6% region, that it closed the financial year 2020. So I think it's still within acceptable limits. And as long as CBN continues its forbearance window, which it just extended to 2022, we might see NPLs, remain moderated. But further out, as the economy, returns back to normalization, we would see asset quality, just improve across the banking industry generally. So I would say it's in an LD space at the moment.
All right. By the way, we see a lot of startups now in the fintech space. How big of a threat are the fintech players to banks in Nigeria? Just briefly.
Yeah, I would say they're becoming a threat. On Thursday last week, we saw the CBN granted approval, to MTN and Airtel's payment service. Grant them payment service banking license, which would also be a competitor to most banks. But what we've seen recently is that most banks are also waking up to ward off the competition, we've seen from the fintech players and also the telco players as well. So we've seen the likes of GTCO, set up separate fintech subsidiaries, to manage this competition. And we've also seen the likes of FBNH as well, wake up to the competition as well. So I would imagine that going forward, most banks would enhance their digital banking offerings, to wade off this competition. And going forward, we would just see, most banks evolve from offering traditional banking services to now offering more fintech services, just to wade off the competition coming from the fintech players. Thank you.
Okay, well, we'll have to leave it there now. Damilola Lukman, banking sector analyst with Chapel Hill Denham. Thank you for joining us on this Business Morning.
Thank you very much.
All right, now for an opening call to the market with Will Ibong. Well, Will, last week, the bear won 3-2. What's your prediction for this week?
If I start predicting the market, it's going to be a bit weird because the market, the series of the market goes up, it goes down, it's a roller coaster. And
okay, Will, it seems we're having trouble with your audio there. Well, just we'll get back to the market in a bit, just after this quick break. That's the moment. Just stay with us.
Hello, welcome. This is the Market Review, but we are talking about something different today because the demand for sustainable finance has surged on the back of the COP21 agreement, and we've seen ratifications, UN ratifications on UN Sustainable Development Goals. Efforts are being made to tackle climate change, and other sustainable topics have become global priority, and finance needs to be part of the solution. Now we have FMDQ Group through the FMDQ Securities Exchange Limited, which is set to be the first financial market infrastructure group in Africa to create a platform specifically for green and sustainable securities. We have Mrs. Tomi Sekondi, Managing Director of the FMDQ Securities here. She'll be joining us to discuss this exciting development. Good morning, Mrs. Tomi, and welcome for coming. Thank you for joining us on the show.
Good morning. Good morning. Thank you for having me.
Great. Why would you just give us a big background? Why the need for the FMDQ Green Exchange here in Africa?
So, as a group, FMDQ Group, we recognize the role that we play in the financial markets and our unique position to be able to promote things or issues that help develop our market. So, obviously, sustainable economic growth is one of those things that FMDQ, that the nation, if you will, is looking into, and FMDQ, because of its position, feels it needs to be at the forefront. Now, for FMDQ as well, sustainability is one of the main, is a main focus for us, a main focus for our business strategy. And that can be seen in the commitment we have to our 5 pillars, sustainability pillars, which are business, markets, our people, our community, and our environment. So because of the drive that, we're seeing around the globe, obviously, and with Nigeria as well, promoting sustainable finance is something that FMDQ decided that it had to be a part of. And because of this drive, because of, our position in the markets, FMDQ Green Exchange, the idea was thought of. Obviously, it's something that we've seen happen in other jurisdictions as well. And we thought to be able to put Nigeria on the map and obviously ensure we keep our position at the fore of what is happening globally. FMDQ Green Exchange was launched.
You just mentioned putting ourselves on the map, the FMDQ, but what differentiates the FMDQ Green Exchange from other exchanges that have been practiced around the world, and how will it function really?
So FMDQ Green Exchange, what it is really, it's a virtual information platform, and it's dedicated, strictly to green and sustainable finance, green and sustainable securities. So the idea of FMDQ Green Exchange is providing relevant data around green and sustainable finance, promoting transparency for green and sustainable securities that have been listed on a regular exchange in Nigeria, particularly FMDQ Securities Exchange. And we're showcasing securities that align with global environmental, social, and governance. That's the ESG principles. So for FMDQ Green Exchange, we're going to highlight the capital flow into investments around the ESG related principles. And we're going to showcase all of that, have a repository for issuers looking to, understand a bit more about Green Exchange, showcase the activities in the green and sustainable space, and also for investors and other stakeholders to be able to get that information. So that's really what that platform will be about. It's a tool for, education, information around green and sustainable finance in
They're
Nigeria.
on the phone, okay.
Okay, so we see that world leaders are currently at the COP26 discussing strategies for a more sustainable future. As a sustainability-focused organization, how does FMDQ Green Exchange fit into this narrative? How do you want to create socially responsible investors?
So the launch of FMDQ Green Exchange, I think, could not have come at a better time, especially in an era where world leaders are talking about sustainability. There are issues around sustainability that need to be tackled. So having a platform that is dedicated to showcasing what it is we're doing in Nigeria helps. And with obviously global leaders being interested more about sustainability, it gives securities exchanges, it sort of puts securities exchanges now in the discussion, and it will also help promote increased activity in that space around green and sustainability. So FMDQ Green Exchange, again, has come at an appropriate time. And as an exchange, as an exchange platform, this is something that, we have started being involved in, right from even 2018. We've tried to promote green and sustainable finance in Nigeria. And even on FMDQ Securities Exchange itself, we've already listed about 5 green securities from the federal government of Nigeria Securities to even corporates. So I think because FMDQ, we already have that experience and we're also learning and obviously being a part of this, I think we are adequately positioned to be able to, support this global drive around sustainability.
Thank you so much, Ms. Tumi Sekoni, for that insight into the FMDQ Green Exchange. And we're hoping that talks with the SEC on the green sustainability program in Nigeria, and we're hoping that would see or come to fruition and we'll see good results at the end of the day. Thank you so much for coming on again.
Thank you very much for having me.
All right.
So, Ladi, that's it for the markets. FMDQ has come up with a great plan.
It's all about
We're
going
just waiting
green.
for that to... It's all about the green sustainability, We're looking at the environment, we're looking at sustainability, and also corporate governance,
Exactly.
Everything, we have to protect the environment and make sure that we are responsible investors.
All right.
So
all right, Will, thanks for that update. We'll get more updates about the market from tomorrow. All right, we'll take a break now. When we come back, we do a call to London with Juliana. Do stay with us. This is Business Morning. Welcome back. Now for some developments in London with Juliana. Great to have you, Juliana. Well, British businesses' output has fallen for the 6th month in a row, with businesses across the economy trying to keep up with rising demand. What's driving this?
Good morning, Ladi. Well, there's a load of different issues, really. I think British business are embracing themselves for a difficult winter. I think the most pressing issue has got to be supply chain shortages. This is not solely a British issue. This is affecting manufacturers across the world. And the number one component is these semiconductor chips that have been running short for about 18 months now, since the demand of technology during the pandemic. This has really been making it difficult for British manufacturers, particularly within the car manufacturing industry. We had some data from the Society of Motor Manufacturers and Traders last week showing that sales have slumped yet again, and this is because several factories across the UK have had to stop production because of this issue. Also, as well, we've got labour shortages. About 1 million vacancies are currently available in the UK. Do people really have the skills to fulfill these jobs? That's a major issue. This data that you're discussing is really just a little piece of an insight from the BDC, which is an accounting firm. They've been conducting surveys with over 100 manufacturing businesses, and they're all saying the same thing. I think as well, in the coming months, inflation is going to be a topic of concern, currently standing at about 3.1%. Last week, markets were expecting the Bank of England to rise interest rates, which would have curbed inflation, but they decided not to do it. And we don't expect that to happen until about February 2022. So, yeah, a lot of difficult weeks and months ahead.
Right, I guess it's the year of shortages here. Well, vaccinated passengers are finally able to enter the United States from the UK, bringing an end to almost about 2 years of coronavirus restrictions. Is it time to celebrate?
Yeah, I suppose so. I'm not, because I'm talking to you. I'm not on a flight. One of those flights that have taken off a couple of minutes ago from Heathrow. In fact, it was a very kind of pompous, ceremonious lifting of 2 carriers, one from Virgin and one from BA. Only the pilots will know how they're doing it, but they took off at exactly the right time. And yeah, great shots for the media. They'll be going to JFK airport, so they should be there in about 8 hours' time. But no, this is great. It's been about 600 days now since the White House cancelled any flights coming from the UK. Of course, there have been flights, but these have only been for key workers and in the latter part of the pandemic for any US citizen based in the UK that was double vaccinated. But now, if you are fully vaccinated over the age of 18, if you're under 18, you're exempt, you can enter into America. And this is a huge win for the aviation sector here in the UK. As most people will know, transatlantic flights are at the centre of UK aviation, and it had been such a long time. Lots of bosses within the industry were calling for some sort of corridor to have been open months before now, but it's taken a long time, but it's happened today. I think the American airspace opened at about 5:01 a.m. this morning, and so far there are over 2,688 flights confirmed between Britain and America this month alone. So it just shows you just how popular that route is. Right.
Anyway, Juliana, we'll get more updates from you later in the day from Business Incorporated. Thank you so much for the update.
Thank you.
All right, on to the crypto market now. We see Bitcoin looking bullish this morning. Let's take a look at the market cap there. We see it's about $2.87 trillion, nearing that $3 trillion mark, up 4.02%. 24-hour volume traded in the total crypto market about $102.47 billion, up about 8.44%. And Bitcoin dominance, we see it inching up there as Bitcoin is looking quite bullish. Let's take a look at the price of Bitcoin. $66,000, broke the 65K range, up 6.62% with a volume at $32.38 billion. Quite a bullish market this morning. Let's bring in Olumide Additional now to bring us up speed. Great to have you, Olumide. Good morning.
Yeah, good morning, Ladi. Yeah. Happy Monday.
Happy Monday. Well, happy bullish Monday, I would say. We see Bitcoin there breaking to 5K, Ethereum nearing the 5K mark. Well, what's driving sentiment?
Yeah, interesting. We're seeing that Ethereum is becoming also a mainstream crypto asset. Bitcoin had already gotten the buying hold of many institutional investors, but Ethereum of late, despite the fact that it has quite expensive gas fees, we've seen that it takes the lion's share in NFT market, and try to understand that according to many top bank analysts, NFTs would triple in the next couple of years. So that's a big market, and Ethereum has a role there. Then also we are seeing across market spectrum that there is a lot of institutional buying across new companies, which I won't want to disclose because of confidentiality. But what we are seeing right now is that the market is maturing, despite the fact that we are seeing concerns of tapering. Bitcoin has been staying over the $60,000 mark for a couple of days, and that just gives you a sign that the bulls are not going out of gas.
Right, the bulls definitely are not. Well, but we've seen meme coins, flooding the market because of the success of coins like Shiba Inu and Doge. Should we be worried about these, other meme coins, springing up, some rock pools, money grabs? Should we be worried?
Yeah, pretty much. That's one of my concerns. But you need to understand that one of the attractions about mini coins are the fact that it has a strong community and the fact that a lot of investors can afford it. The most expensive mini coin, and if you look at Dogecoin, for example, it sells less than $0.50. That gives you the fact that a lot of people can afford that. You can't compare that to Bitcoin and Ethereum. So the positivity around it is that it gives retail investors easy entry to the market. But just like you said, we're seeing so many questionable crypto assets that definitely a few days ago we saw what happened to the Squid Game token, where investors lost virtually all their funds because the developer absconded with the project. That just gives you the concern that we have questionable meme coins. So investors should be pretty wary about just flocking any meme asset.
All right, and with Bitcoin and Ethereum, looking strong, what can we expect for the week?
Yeah, the week, it tells you that the momentum is still with the two leading crypto assets. But I'm expecting that at some point we'll see saturation, because if you look at the chart, you see that the buying pressure wasn't like what we saw in the last 2-3 weeks. So I'm seeing the market consolidating, except we see a major news across market. And reports suggesting that Elon Musk might sell selling some of the Tesla stocks, moving to Doge might trigger some crypto bullish excitement. But it's left to be seen what really happened at the end of the week.
Right, Elon Musk back in the news again with his meme coins. Well, Olumide, always good to talk to you. Thank you so much.
Yeah, thanks, Alex.
All right, and that's a wrap on the program. Don't forget to join us at 1:30 on Business Incorporated for more updates on developments in the world of business. Thank you for watching. I'm Ladi Williams. Bye for now.